Welcome to another video. So in today's video, we're looking at depreciation, and one of the methods of depreciation, which is called reducing balance method or diminishing method. So either you call it reducing balance or diminishing. So that this is one of the methods of calculating or computing depreciation. Now, under this method, the annual charge is computed by applying fixed percentage to the cost, then less accumulated depreciation. Do you get it now? So it's computed by applying a fixed percentage to the cost, then with less accumulated depreciation. Now, because of the fixed percentage in which you are applying, amount charged as depreciation will continue to decrease as the year passes. Do you get now? So we are going to solve question and you are going to look at what I just said now. So I said diminishing method or reducing balance method, either ways. So there is a formula to calculate the rate. Sometimes the question may give you a rate, and if the question didn't give you a rate, you have to look for the rate, because they will be giving a rate in which you are going to charge the cost to get your depreciation. Now, for in a case whereby you are not giving the rate, to get the rate under reducing balance method, the formula is given by 1 minus the nth root of scrap value. Scrap value is also known as residual, or you can say salvage value, divided by the cost of the asset, then multiplied by 100. The result here, you multiply it by 100. In a case whereby you are not giving the rate to charge your cost in order to get the depreciation, you are going to apply this formula to get your rate. Now we have an example on the board. Let's cite that now. So when we go through the what we have on the board, the question says that Mr. Block has been trading for many years, making up his account to 31st December. On 1st, on January 1996, so there is on 1st January 1996, he purchased machinery for 775 naira, 775,000 naira. He provide depreciation using the reducing balance method at the rate of 20%. The machinery was disposed of on 1st January 1999 for 400,000. You are required to prepare the following account. The first thing is to calculate the depreciation using the reducing balance method. And thank God, in the question we have here, we have been given the rate. Therefore, to calculate the depreciation, there won't be any problem. So we don't need the formula to calculate the depreciation which was charged for each year. So first thing to do is to write the name of the person that owns the account, and that is Mr. Block. So this is a question from Institute Chartered Accountants of Nigeria. A question from Institute Chartered Accountants of Nigeria. Now, to calculate the depreciation, depreciation. Now, we are going to start with the first year, Naira year. Sorry, let me change this. So the currency Naira. Then the first, don't forget, the question says you purchased the machinery on 1st January 1999. So for the first year, which we are going to write 1999, 1996 rather, we are going to start with the cost of machinery, which is 1st January. The cost of machinery at 1st January is 775,000 naira. So the next is the depreciation charge. Depreciation charge and that will be 31st December of the same year. Don't forget, depreciation is charged at the end of a year. Depreciation is charged at the end of the year. So the depreciation charge will be, don't forget the rate is what, 20%. So we have 20% of the cost, which is 775,000 naira, and that will give us 20 multiplied by 775,000 naira divided by 100. So that is 155,000 naira. So we are going to less it. When we subtract this gives 620,000 naira. So the 620,000 naira is called net book value or carrying amount. Net book value or carrying amount at the end of that year. So you can write carrying amount at the end of 31 of December. So we will move to the next year, which is 1997. So for 1st January 1997, the amount of assets will be the carrying value of the end of last year. So the carrying amount or the net book value at the end of last year is going to be the asset or the carrying amount or the net book or the cost of asset for the next year. Do you get now? Anyone you want to call it. So the carrying amount is going to be this, which is 620,000 naira. Then we are going to charge depreciation at the end. So depreciation charge will be 20% of the carrying amount, which is 775,000 naira. So this gives, sorry, 620,000 naira divided by 100, then multiply by 20. So we have 124,000. Then we subtract this. This gives 496,000 naira. So the 496,000 naira is the carrying amount. Don't forget, I said it the other time, carrying amount is the same as net book value at the end of the year. So when we move to year 1998, because the question says that how many years was given, it provides for at the rate of 20%. The machinery was disposed of on 1st January 1999. So the machinery, the what at 1st January 1999 is the what at the end of 1998. You get my point now? The value, the net book value or the carrying amount of the asset at the end of 1998 is the value or the cost or the carrying amount, or you can say the net book value, anyone you want to call it, at the beginning of 1999. Don't forget, the way we are solving this, the balance at the end of 1996, the carrying amount is the amount of assets or the carrying amount also at the beginning of 1997. So that is what you need to understand when you are computing your depreciation. Now, we say that 1st January, at the beginning, we are having carrying amount to be 496,000 naira. 31st December, depreciation charge. We have 20% of the carrying amount. So and this will give multiplied by 20 divided by 100. So this give 99,200. So let's subtract it. Then we have 396,800. So we say that 31st December, the carrying amount, which is 396,800. So first of January for year 1999, the first of January, we are going to have the carrying amount to be 396,800. So the year, don't forget, the machine was disposed on 4th January 1999. So this was the worth or the value or the carrying amount, you can say net book value or carrying amount of the asset at 1st January 1999, which is the also the amount or the value of the asset at the end of 1998. So we have calculated the depreciation. So the amount charged for each year, we can see the first year, during the first, at the end of the first year, at the end of the second year, at the end of the third year. These are the amount charged as depreciation. Now let's move to the what we are asked to prepare. The first thing we are asked to prepare there is the machinery account. So for A, we are going to start with the machinery account. So we have the debit, we have the credit. Machinery account. And don't forget, for asset, it has a debit balance. So we'll move to the debit side. Then the value of the machine at first 90 90 1996. So let me write 1st January, 1996. We have the value of this asset in cash to be cash or bank. So we don't know whether it is cash or bank. So let's write cash or bank. So the value of the asset at first when we purchased the asset was 775,000 naira. So 775,000 naira. Now, at the credit side, we are going to have disposable account. The reason why we are having the asset disposable account at the credit side is that at the end, we were told that at the end, we dispose of the asset. That is, when we are talking about asset disposable account, it is a temporary account which we use when asset is being sold. So for the sales of fixed assets, we use asset disposable account, which is also, as I said earlier, it is a temporary account for the sales of fixed assets or non-current assets. So at the credit side, which is at the end of the year, so we are going to say that 1st January 1999, we dispose of the asset. So we are going to have asset dispose disposal, and the value is the same with what you have here, which is 725,000 naira. Therefore the account closed each other. So what this is trying to tell us that the value of the asset, the time we purchase it, did it in cash or bank, and at the end of the useful life of the machinery, we sold it out, right? So the amount also is going to the asset disposable account in order to close down the machinery account, because the machinery account is no more recognized our book of accounts. Let me put it in that way. It's no more recognized in our book of accounts because the time for recognition, or there is no recognition for the machinery again, since the estimated useful life of the machinery has come to an end. So it does not have any life, no use anymore, and we have disposed it off. So we have to close down the account. The next part, which is provision for depreciation account. Now, one thing you should note is that provision for depreciation account has a credit balance because it is an income account. So we are providing money for depreciation. Do you get it now? So at the credit side, we are going to start with the amount charged at depreciation. The amount we charge for depreciation at the for the first year, which is 31st December 1996. So don't forget, when we are calculating it, the amount we charge, depreciation charge for 31st December 1996, that is, I still remember, which is 155,000 naira. But don't start like that. You are going to start with the date, 31st December 1996. So you are going to start with, or you can write it like this: year 1996. So we have 31st December. The amount is going to our profit or loss account. So don't forget, profit or loss. Just write profit and loss there. Then we will move to the debit side. You now write it as, for 1996 December, we have the balance carry down, which is also 155,000 naira. Then you close it for that year. And don't forget, for balance carry down is also at the end of the year. So balance carry down, therefore we are going to have what? Balance brought down. The balance brought down will be the amount for the next year. So we are going to write for 1st January, we have balance brought down. So balance brought down is for the beginning, which is 155,000 naira. Now, at the end of 31st, at the end of the year 1997, which is 31st December 1997, the depreciation we charge, the amount was 124,000 naira. So we have 31st December profit and loss, because the amount is going to the debit side of the profit and loss account. So you are adding the first year depreciation to the second year depreciation. Then we have a total of 279,000 naira. Then we close this up, 279,000 naira, which simply means that 1997. So we have balance carried down, and balance carried down is for the end of the year, which is 31st December. So the balance carried down is this total, which is 279,000 naira. When you bring this back here, for the year 1998, we are going to have 1st January balance brought down. So which is 279,000 naira. So at the end of year 1998, the amount we charged for depreciation was 99,000. So 31st December profit and loss account. So we charge 99,000 naira. Now adding all this, sorry, it is 99,200, not 99,000 naira. So adding this together, we have 20 here, 8, 7, then 3. So we have 378,200. Then we move to this side. The total also will be 378,200. So 1998, 31st December, balance carried down, which is 378,200. So we are going to have January, sorry, I said January 1999, then 1st of January 1999. The balance brought down, which is 378,200, and this is telling us about the accumulated depreciation, the total depreciation we charge for the year before the disposal hey, before the disposal of the asset. So here at this debit side, we are going to write asset disposal, the same time, which is 1999, 1st January, asset disposal. So because on 1st January, it has been written in the question, the machinery was disposed of in 1st January. So we are trying to tell us that the accumulated depreciation during the time we disposed the assets was 378,200. Now this leads us to the last part, which is the asset disposal account. So for the asset disposal account, we have the debit, the credit, asset disposal account. So at the debit side, we are going to start with the cost of the asset. So 1st January 1999, starting with the cost of the asset, we have what cost, which is 775,000 naira. And I did say this the other time, for asset disposal account, we use it to determine whether we made profit or loss when we disposed of the asset. On the sales of the asset, is either profit or loss. So we use the asset disposal account to determine that. At the debit side, you are going to have the cost of the asset, and at the credit side, you are going to have the scrap value, or the amount in which we sold out, we disposed of the assets, with also with the accumulated depreciation. So the difference, if this credit side is greater than the debit side, it will give us profits on the sales of the assets. Now let's move on. So here now, the same date, 1st January 1999. So we sold the assets 400,000 naira. So when we disposed it off, the amount was 400,000 naira. We don't know whether it is a cash or bank, so we are going to write cash or bank. 400,000. Then the accumulated depreciation. So the accumulated depreciation, we are going to derive that from the provision for depreciation. So we'll just write provision for depreciation. The balance is what? 378,200. Now we are going to add this up. The total will give us 778,200. Here also we have 778,200. We can see that the credit side is greater than the debit side, which means that we add a profit on the sales of the assets. So profit on sales, the difference here, which is 3,200, is the profit on sales. So what we are asked to prepare, we are asked to prepare only machinery, provision of depreciation, and asset disposal account. But in a case whereby you are asked to prepare all the necessary accounts, the last account you need to prepare is called the profit or loss account. So we just do that in short. This is not part of what we are asked to do, but let's just do it in case of you coming across any other question. So the last part there is debit, credit, profit or loss account. So if you are asked to prepare the profit or loss account, it will move in this way. All what will be on the debit side is the amount charged as depreciation, since depreciation is what? An expenses. So the year, we know that the year is what? January. The first year is 31st December 1996. For 1996, the amount we charge as depreciation, that is 155,000 naira. For 1997, depreciation, which is going to be 124,000 naira. Then for the last one, 31st 1998, depreciation charge, that is 99,200. So these are the amount you charge at depreciation. So at the credit side of your profit and loss account is your income, and one of our income is what? Profit on sales. So we'll move to this side. We have what? Profit on sales, which is 3,200, and that is for 31st 90, or we can just say that 1st January 1999. 1st January 1999 is for 31st December 1998. So this is how your profit and loss account is going to look at, in case if you are asked to prepare the profit or loss account. Also, then we have come to the end of the account. So what we have done today is how to calculate using reducing balance method, or you can call it diminishing method. And when you are asked to prepare necessary accounts under it, these are the necessary accounts you will be asked to prepare, which you have just done. So thank you for watching. Please don't forget to like, share and subscribe to my channel. Bye. Love you all.